Good evening. You're watching the Economic Reality Check, and tonight the headline is this. The global economy looks strong on the surface, but underneath, the cracks are getting harder to ignore. Stock markets are still rising. Employment data still looks solid. But inflation, debt, and energy prices are quietly pushing the system toward a turning point. Critics are calling the Great Reset of 2026. Over the next 5 minutes, we'll break down what's really happening behind the green numbers, what's at risk for your wallet, and why this moment may be more dangerous than the headlines are admitting. Let's start with the United States. The latest jobs report for April shows stronger than expected hiring, with unemployment holding around 4.3%. At first glance, that sounds like a sign of strength. But here's the twist economists are warning about. Even as the job market stabilizes, inflation is still not under control. Prices for services, transport, and energy are staying high, and the Federal Reserve is now more focused on inflation than on rushing to cut interest rates. So what does this mean for you? It means the economy may still be creating jobs, but it is also slowly eroding your purchasing power. The same paycheck buys less at the pump, less at the supermarket, and less in the housing market. We're not in a collapse, but we are in a squeeze phase, and that makes 2026 far more dangerous than a simple good economy. Bad economy headline can explain. Now let's talk about the real cost of borrowing. Interest rates are not falling back to the zero era anytime soon. Recent data shows inflation is still above target, and the Federal Reserve has signaled that any rate cuts will be cautious and limited. That means the cost of money stays high for everyone. Homeowners with mortgages, students with education loans, small businesses trying to expand, governments issuing new debt. Higher rates also protect savers and pension funds by giving them better yields, but they punish borrowers and risk takers. This is the core contradiction of 2026. The same policy that helps savers can hurt borrowers and slow down the broader economy. If inflation does not cool down, the Fed may stay more hawkish, and that raises the risk of slower growth, higher defaults, and stress in the financial system. Now let's zoom in on the debt trap. When rates stay elevated and growth slows, debt stops being a tool and starts becoming a time bomb. Credit card use, auto loans, and student debt are already under pressure in many economies. Delinquency rates are climbing in some consumer categories, and that is a warning sign that households are stretching their budgets as far as they can go. This is why the idea of irrational exuberance is so dangerous in 2026. Stock markets may still be rising, but many households are quietly over-leveraged. If inflation stays high and interest rates stay high, even a small economic shock can trigger a cascade of defaults and fire sales. In short, the economy works as long as people keep paying, but the higher the debt, the thinner the margin for error. Now let's shift to China. Headlines in early 2026 show China's GDP growing stronger than expected, helped by industrial activity and exports. But the story underneath is more fragile. The property sector remains weak, and housing is still a major source of stress for households, banks, and local governments. When property prices fall and confidence drops, consumers spend less, and when they spend less, growth slows down. Even if factories keep producing, China's economy is in a narrow lane. Keep exports and industrial growth alive, while trying to avoid a deeper property crash. If that balancing act fails, the shock won't stay inside China. It will spread to global trade, energy, and commodity markets. For viewers watching from Australia, Europe, or the Americas, that means weaker demand for exports, more volatility, and less certainty about global growth. Now let's zoom out to the big picture. The IMF has already cut its global growth forecast and warned that the world could enter a recession if energy and geopolitical shocks worsen. This is not a prediction of immediate collapse. It is a warning that the global economy has very little cushion left. Higher inflation, high debt, and fragile consumer balance sheets all reduce the system's ability to absorb the next shock. Oil is still the wild card. If energy prices jump again, transport costs rise, manufacturing slows, and inflation can reaccelerate at the same time. That growth is already weak. That combination is what economists call stagflation, slow growth plus high inflation. And that is the nightmare scenario for 2026. Not a single crash, but a slow, grinding squeeze that damages households and businesses over time. Here's the final takeaway. The illusion of prosperity in 2026 is built on 3 things: high stock markets, still resilient labor markets, new technology hype, Especially around AI, those things are real. Stock prices are high. Jobs are still being created. AI is changing industries. But none of that cancels out inflation, debt, or global fragility. If investors and viewers confuse innovation with immunity, they will be the first to feel the pain when reality returns. The Great Reset of 2026 is not a conspiracy. It is the moment when the market's fairy tale story collides with the real-world math of debt, interest, and inflation. Before we finish, here are 3 concrete actions you can take. Recheck your debt. If your interest rates are adjustable, ask how much your monthly payment would rise if rates stay at current levels. Stress test your budget. Imagine inflation stays 1 to 2 percentage points higher than headline numbers say. How much would that change your spending? Watch the exits. Don't mistake a calm headline day for a safe long-term environment. Markets can turn quickly when the fragile pieces finally break. This is the economic reality check. The music is still playing, but the exits are getting narrower. Until next time, stay informed and stay prepared.